Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week I talked about the central banks, and it was a key week in terms of central bank announcements. Now, the Bank of Japan and the meeting from the Bank of England largely passed without much impact on markets, but it was always going to be that the US Federal Reserve and Jerome Powell were going to be the highlight of the week and were likely to have the biggest impact on investment markets, which they ultimately did. Now, Jerome Powell, after the decision by the US Federal Reserve to do effectively not much and keep things as they were in terms of monetary policy, the investment markets were looking keenly at what was written in those minutes and what Jerome Powell said after the announcement. And Jerome Powell he went to great pains to emphasize the fact that the US Federal Reserve wouldn't be doing anything, wouldn't be rushing to unwind QE or raise interest rates. So he was telling the market everything that it wanted to hear. In fact, he was very, very dovish, which actually caught the market slightly by surprise. Now, if you look at what the markets did in the immediate aftermath of those announcements, as I asked you to do on last week's show, because it's very interesting to see the dynamic and the correlations between different asset classes. You would have seen that the gold price jumped 1% in the immediate aftermath of that announcement. In the hours that followed, we saw technology stocks pick up, not massively, but we saw about a 0.5% rise in a number of the big tech stock names. We saw emerging market assets do quite well because the dollar weakened. So when the dollar's weak, that tends to be good for emerging market assets. And we saw some of the reflation trade winners underperform slightly on a relative basis. Now, by Thursday, the market tone had changed quite a bit. The market had digested what Powell had said, and they hooked onto the fact that inflation would be allowed to run a little bit hotter for a period of time. So the reflation trade was well and truly back on. And what it meant is we saw a big spike in the 10-year US Treasury yield, because that was one of the key indicators I said to watch after the press conference was made in the days that followed. And we saw the US 10-year Treasury yield jump from around about 1.66, 1.68 at the point just before Powell actually spoke. Within 24 hours, it jumped to about 1.74%. So it was a big leap in the 10-year US Treasury yield. It was actually a 14-month high. So you could argue that Jerome Powell had made a bad situation far worse. And we saw the NASDAQ 100 fall 3% on Thursday. And conversely, we saw the Dow Jones do well on a relative basis. So the reflation trade was well and truly back on. We saw the dollar strengthen, which is always bad news for emerging market assets. So we saw the winners that we've experienced since mid-February, when the reflation trade and bond yields really started to become the main focus of investment markets. So those winners do start to do very well again, and those things that had been underperforming during that period, namely technology stocks, they started to lag. Now, moving into this week, it's as if the market has suddenly remembered something it had forgotten about, and that something is the pandemic. Now, we've had a positive rollout in the UK of vaccinations and in the US, and of course that's why the reflation trade has really taken hold of investment markets. The overall consensus is that the economies will start opening up, and therefore we're going to see a big boost in economic growth. But of course, there's been rising cases of COVID in Europe, and we've started to see lockdowns in France, in Italy, and threats of lockdowns in Germany. And of course, there is obviously the row over the export of vaccinations from Europe to the UK, for example, which has started to put under threat our own vaccination program. So this has all started to raise concerns in investors' mind whether the pandemic is going to come back. And of course, you are continually getting news from places like India, where they have found new variants of COVID-19. So suddenly the market this week is taking a step back and thinking perhaps they need to be a little bit more concerned about the pandemic, and maybe they've got ahead of themselves. Now, we'll have to see how that pans out in the days and weeks ahead. But what it means is in the last 24 hours, for example, those pandemic winners, so we're talking technology stocks, have done very well. Those reflation trade winners, so we're talking energy stocks, financials, have done badly in the last 24 hours. And you're starting to notice that the NASDAQ is trying to play a little bit of catch up with some of the more broader indices such as the Dow Jones or the S&P 500. It's still got some way to go. But if you look at the market overall since the start of the year, then most indices are still in positive territory despite the pullback that we've seen. The pullback has been focused primarily on emerging market assets. It's been primarily on technology stocks. So if you've held those, and of course government debt, those are the assets that have underperformed in your portfolio since about mid-February. But some of those were coming from high bases. So Asian stocks were up double figures percentage-wise by mid-February since the start of the year. So that's why they're still in positive territory. So will we have a turnaround in some of these assets in the next days and weeks ahead? We'll have to wait and see. Of course, on top of that, the Biden administration has met for the first time with Chinese officials. And that meeting, by all accounts, didn't go very well. So that's why we've also seen some strain and downward pressure on Chinese stocks this week. So overall, the reflation trade is still there, and it's what's driving markets. But question marks are starting to be raised over these concerns with the pandemic and COVID-19 and lockdowns, particularly in Europe. Now, if you look at the pound's always interesting for UK investors. It impacts the returns you get on overseas assets. Now, the pound has weakened somewhat. In February, we're up to about $1.42. Now, it's fallen to under $1.37 in the last few days. And that's been because we've had weaker than expected inflation figures come out. We've had disappointing employment data, and of course the vaccine debate and that possible blocking of imports of vaccines from Europe. That has all hit the confidence in the growth of the UK economy and therefore the pound. And that's why you've also seen a little bit of weakness in the last couple of days in small cap stocks. So look at the sort of small to mid caps, look at the FTSE 250, for example. So at the moment, if you wrap all that up, it's perhaps not surprising that the VIX is down to around about 20. That's the fear index, which is a measure of that sort of future volatility expectations in the S&P 500. But it's a good indicator of fear in markets. It's still around 20, which is the long-term historical average. It broke down below 19 this week, and the VXN, which is the equivalent for technology stocks, is down to about 28, which when it was above 31, that was obviously when we were seeing spikes in volatility. The general fear in markets isn't extreme. The greed isn't either. In fact, it's fairly neutral, and that perhaps is reflecting what we've seen in markets since the start of the year, where we've seen some strong rallies and pullbacks. But a lot of markets, particularly in America, are still near all-time highs. So at the moment, the market isn't panicking. We'll have to see what happens with bond yields. They could rise further, as I mentioned in last week's episode. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Twitter is moneytothemasses with the number 2. You can obviously find us on Instagram, Facebook, and don't forget to subscribe to our YouTube channel.